our, oh, I'm sorry. I apologize. Bye-bye. Bye-bye. I gotta go. I'm sorry. That was my grandkids interrupting. You know I had to say at least hi. My name is Jennifer Willis. I'm the first vice president of the National Coalition of 100 Black Women. I want to welcome everyone to our presentation today on insurances and investments. And I'd like to start by having our president, Dr. Elizabeth Sherrill Davis, provide you general information about our coalition and to welcome you as well. Dr. Elizabeth?
Thank you, Jennifer. Good morning, my lovely, beautiful, most fabulous sisters. So welcome to the National Coalition of 100 Black Women Sacramento chapter. Today we're going to talk about investments and insurance, which is so very important. Before I go into talk about the chapter, I wanted to share this story. I was just thinking this morning about Phyllis and investments and insurance. So we all have, you know, mothers that tell us what we should do, what we should not do. Some of us listen and some of us don't. So for myself, I heard her telling me when I got married the importance of insurance, life insurance. Did you get your life insurance? When are you getting your life insurance? I kept saying, okay, Mom, I'm gonna do it, I'm gonna do it, I'm gonna do it. She said, okay, you're not gonna be happy until something happens and you don't have any money. Don't call me. I done told you to get your life insurance. Well, I did get the life insurance. In 2003, I lost my husband of 18 years. And I didn't know at the time that how important that insurance policy was. Right. I had a child in college, and anytime you lose a spouse or you lose anyone, your whole entire life changed. And my life changed. So from that point forward, in terms of insurance investments, and we're also going to do a topic on living trust. I welcome you all to sit in on this information, take away the information, because this is our livelihood. Insurance investments and estates is so very important. So with that being said, I just kind of wanted to share my story regarding that. And I thank my mother every day for instilling the knowledge that I need to be successful as an African-American woman. So again, I'm Dr. Elizabeth Sherrill Davis. I'm president of the Sacramento chapter of the National Coalition of 100 Black Women. Before we begin the program, I just want to provide a little bit of history about the National Coalition of 100 Black Women.
Elizabeth, can you hold on just a second?
Sure.
Thank you. I'm going to mute everybody except for Dr. Elizabeth so that we can make sure we hear her. So hold on just a moment.
So Jennifer, before you mute everybody, did anybody else, did your audio cut off for a moment when Dr. Elizabeth was speaking? Because mine cut out.
No, we continue to hear.
Okay.
Okay, I'm going to, if you need to speak, I need you to, wave at me or do something, because I'm not going to allow you to unmute yourself. I'll have to do it for you. So Elizabeth, let's see here. Mute all. No. Okay, so here. All right, Elizabeth, can you talk?
Can you hear me?
Yes, I can hear you. Thank you so much.
Awesome.
All right, go ahead. Thank you.
Okay. The National Coalition of 100 Black Women Sacramento chapter is a nonprofit volunteer advocacy organization. We were chartered in 2001. We comprise of professional African-American women. We're dedicated to public policy, economic empowerment, education, and leadership development. The National Coalition of 100 Black Women Sacramento chapter, we are one of 61 chapters in 25 states, and that includes the District of Columbia. With approximately 2,800 members, we're all working collectively and the community to provide knowledge and resources in the following areas: economic empowerment, financial literacy, pay equity, investments and insurance, living trusts, wills and probate, investing for the future, money management. Some of our health initiatives are metabolic syndrome, which we know in the African American community, we have a very high percentage of heart disease, diabetes, and stroke. We also focus on breast cancer awareness, mental health, healthy lifestyles, and child obesity. In terms of education, we have a summer reading program. We take high school students on college tours. We provide scholarships, and we work with, we partner with the Huntington Learning Center for the ACT, SAT preparation courses. We're introducing a STEAM program, which is science, technology, engineering, art, and math at Soroptimist Middle School. Our public policy focuses on voter registration, the 2020 census, and voter education and registration 2020 census. Our signature mentoring program is called Fostering Hope. This year we had a Summit 2020, which focused on Black girls in technology, educating our young girls about STEM and STEAM coding career opportunities. In our fund development, we have an annual signature luncheon due to COVID-19, has been postponed to 2021, and also the big day of giving. Those are just some of our core programs, and we work very, very closely within the community. The National Coalition of 100 Black Women, our core values are gender equity, inclusion, respect, racial and social justice, accountability, economic empowerment, and collaboration. With that being said, again, good morning and welcome to the Insurance and Investments Workshop. At this point, I'm going to turn it back over to our first Vice President of Programs, Jennifer Willis, and thank you so very much. Jennifer?
Thank you so much, Dr. Elizabeth. We appreciate your valuable information. At this time, I just want to make sure that the screen sharing is on and that the PowerPoint presentation is up. Can you give me the thumbs up if it is? Okay, thank you, thank you. Phyllis, are you off mute? I tried to off mute you.
Yeah, I'm off mute now.
Perfect, perfect, thank you. Let me take this all the way up. I'm not sure how to do that here. Oh, here we go. All right, so hopefully this is okay and I can press it up and down. Just let me know when.
Okay. All right, well, good morning, everybody.
Good morning.
It's good to see you all this morning. I guess I can start off just telling you a little bit about myself, introducing myself to some of you all that may not know me. As Jennifer said, my name is Phyllis Johnson. I am currently an Allstate agent. I have an office in West Sacramento. I have been an Allstate agent in November, be 4 years. After November, I'm going to take on a new adventure trying to do this thing by myself. Just so you all know. So you all the first to know my secret. So,
Right.
So I've been insurance with Allstate as just selling property and casualty for about 4 years, but in the investment industry is where I met Jennifer. We were in that industry together. I've been in that industry for about 20 years. So I'm originally from Memphis, Tennessee. I've been married to my husband this year, be 25 years. We have the anniversary coming up. So
Right.
No special things with COVID, but okay. I'm here. I want to thank you all for joining us this morning to learn a little bit more about insurance and investments. Okay. So Jennifer, can I change the slides or will you change them?
I think I can. Go ahead.
Okay.
Just tell me.
So we're going to cover we're going to just do some basic covering here. on insurance and investments, ladies. First, we're going to, property and casualty. Under that, people use, this is going to be your basic renters, your homeowners, your insurance. And I think we had another slide. So it should be personal umbrella insurance should be in there. I guess I left that one off. Life insurance, we're going to go over things, the term life, whole life, and the UL. And we're going to just tell you about the different things, how these things work, what you should look for, and know that you should be at least talking to your insurance, whoever your insurance person is, at least once a year to look over these things and make sure that you have everything included. And so if something happens, you will be insured and you don't have any small mishaps, okay? So first off, I always like to start with renters insurance because everybody don't own a home, but if you don't own a home or you live in an apartment or renting a house, it's important to have renters insurance. It's a small fee that will save you lots of just heartache and pain. Most people just don't even know about, that they should have renters insurance. Renters insurance is going to protect any personal property you may have. And some people will come in, sometimes I'll see they have a gorgeous wedding ring on, don't have renters insurance. We need those things insured, for theft. If someone they think those things will be covered, like in their car insurance, somebody breaking your car, we have these expensive iPhones now, $1,000 piece, somebody take that out of there, it's not going to be covered under your auto insurance. That's going to have to fall back to your renters or your homeowners insurance. So make sure you're covering your personal property. So in the thing about renters insurance too, I have people that, I've had some clients that, they're in their apartment, their water heater broke, water everywhere, didn't know that, they went and paid. I was like, no, you don't know. You have renters insurance. Went paid all that out from, get all this stuff back. So renters insurance is important. So homeowners insurance here. So homeowners insurance, it's going to be, you're going to have that no matter if you have a home and you're paying a mortgage. Most of the time they're, as we all know, they're escrowed. You're going to have this, but you want to make sure you're adequately insured with that. This is our most expensive asset, right? We want to make sure we're covering our personal property in there, and a level, it's a level of personal protection for us. Next slide, Jennifer. Okay, so here are some of the things here that you want to make sure is covered in your homeowner's insurance. I've highlighted some things here. So first, let's go to dwelling. On the dwelling, this is what's going to cover your home. If anything, if we come out completely disaster, burned down or anything, dwelling is what's going to cover the home to build it back up. This protection is important. If you have this protection, I always like to tell people they'll look at this and say, okay, well, my home is worth $800,000, but it's only the dwelling protection is only $600. Yeah, so this protection should not equal to the home value because you can't value the land in there because you don't need to insure, you can't insure land. So, but you want this to have adequate protection in your dwelling protection. Every year, I suggest that, when you talk to your insurance agent, you look at that to make sure for them to run a new calculation that if something happens, because, they have different things that you may have come into effect, and, now homes are required to have sprinkler systems. So now if you've had a homeowners insurance policy, hadn't had a review, still saying dwelling protection 15, 20 years ago, I go to sometimes review people's, I was like, wait a minute, we have to recalculate this. If your home burned down, you won't be able to build it back again. This is what happened to most of the people that were up in the fires last year. This is why these people could not get their homes back. They hadn't had their insurance reviewed for years. And when it came back, that homes were burned down, they couldn't build them back up because they didn't have enough dwelling protection. So this is important, all right? So, the family protection is going to protect you from any financial loss. If somebody comes to sue you, injury or damage or anything like that, all right? So your guest medical, always important. If somebody comes, trips over your rug, fall in your pool, whatever, or Elizabeth with your beautiful thing falls off that beautiful ledge of yours, there you go. That's where you're going to be in the liability, right? So the personal property, this is going to cover all our belongings, right, in our home. But I always like here in the red, the personal property reimbursement. I always encourage homeowners to include it. This is going to be an extra protection for you because I would rather if you lose, your valuable watch, diamond ring, or painting, this is going to it's going to protect you that you could have this protection at the current value today, right? It's these other protections, the personal property protection is going to be a limited protection. But if you have the personal property reimbursement added to it as a rider, that's going to protect you at your current value, because you want to be able to replace those things at the current value, right? The other structures on here, these are important too. Some people, that you go build different sheds and things outside, or you have things that you'll build outside, like a outdoor kitchen. You want to have those things insured. Add them to your insurance rider. Most people think about you add these things, but you do need to add this to an insurance rider so you can have the protection that you need in case something happens to those. Additional living expense. This is important. So this is, if you don't, now they used to have this as just a current standalone that was on insurance policies. Once they had the big earthquakes out here in California, they limited these. So they add this as a additional protection. You want to make sure you have this on your policy. Again, in case your home comes inhabitable, you want to have additional living expenses. I have one of our coalition sisters that I was talking to once before. She was living in her home when they had something happened there, and she was like, "Oh, we had bugs." I was like, you had to have. She didn't have the additional living expense added to her policy. So you had this on there. They would pay for your hotel wherever you want to stay. Rent it up until they had that done. She said they lived in that for like 6 months. So I always tell people, make sure you have this. It's something you want to have because you never know what may happen. Okay, extended coverage. For your jury first, if you have expensive paintings or anything in your home, these things need to be scheduled on your policy. So, those Rolex watches, anything, make sure we call in to your insurance provider. And if you have expensive things in your home, have those added. It's a small price to pay. They're usually about these, to extend coverage on these things are usually only about $5 for the whole year. So call to have those things done. Make sure you review your policy to make sure those things are on there. Okay.
Next.
Yeah. You got the next slide, Jennifer?
Is that it?
Mm-hmm.
Okay.
Is that the next one? That was the next one?
Let me go back.
Yeah, I think we had another no home. Okay, yeah, that should be it. Okay, you're right.
Okay.
All right. So car insurance. So these are the biggest things we have here to explain when we're looking at car insurance. These are usually always required where this is full coverage here. But the bodily injury and the property damage, this coverage, you can read there, but this is going to help you protect you from accidents that your fault. Now, so Jennifer, yeah, go to the next screen.
I apologize.
That's okay. That's all right.
I was trying to figure out how to do a screenshot, so I apologize.
No, I want you to make this available because this will be a good resource for people to have when they're going to and making sure they're reviewing their policies. Because sometimes when we go to our next slide, I'll just go to I'll speak on the next slide this way here. So on this slide, we can see exactly, this is for someone that has a renter's coverage, right? But the bodily injury, the personal property, uninsured motorists and things of that nature, the bodily injury, the property damage, you see in the blue, you see on the bodily injury, you see current carrier 10, 100, 300. That's probably because I took someone here that had a home or something like that. But you can see what their current, I can see what they currently have with their current provider. But the property damage, the second line, very important, ladies, here. This current carrier, this person only has $50,000. This is what will get you in trouble the most when you have an accident. Do not let your insurer or anybody, this should never be under $200,000. And I'll tell you, the difference between the $50,000 and the $200,000 is probably pennies. But what you would see most of the people or insurance companies would do here, and if you have an insurance agent that's not in your best interest, because if you're our insurer and you're having an accident and we have to pay those out, that goes against our loss ratio. So what I would see sometime I'll see, some agents would do, they'll lower this thing here because this is what's going to cover you. Because if you have an accident or have something that's over this $50,000, it's going to come out your pocket, right? So Any damage, sometimes I'll see people with this thing at $5,000. Now we can't buy a car for $5,000. You can't buy, a fender, I'm almost now for $5,000. So make sure that is at $200,000 no matter, or above, but you don't want it to go under under 200,000. Go back one slide, Jennifer. Okay. What I want to show you here also, so collision and comprehensive, this is the difference we have when we're having in our car insurance. Now, collision, I always tell people, is anything that you're going to collide. Anytime you collide with anything or anybody, that's what's going to be a collision claim. Now, it's a big difference. So comprehensive is going to be anything else. Now, important thing to know, I'll just tell you all the secret now. So when the collision, you could, if you're on the expressway or anything like that, animal will jump out in front, the animal or anything hitting you is going to be the only thing that they're going to say, okay, no, that's not going to be a collision. They'll make it comprehensive, right? So I always tell people on your comprehensive claims, you're probably going to have more of those. So you want to make sure you want to have a cheaper deductible on your comprehensive because, you want to pay less out your pocket. So I will lower the deduction on on my comprehensive coverage, and the collision could be a little higher if we're trying to, save dollars there. Okay, Jennifer, you can do the next slide.
Keep going.
Yeah, go to the next one for the renters. Now this is one for the homeowners. Now, this is most important here. So as you all can see, look, you see on the bodily injury, we have the 100-300, the property damage carriage is only 50,000. Look, now the uninsured motorists on the current carrier, if you can see, they have the current carrier, you have 100-300 on the bodily injury, but on the underinsured motorists, you only have 30-60. Do not allow your carrier to do this to you, okay? Because now you're underinsured, okay, on someone else's stuff. You want these two numbers to match. So if you can see under the limited deduction in premiums, these are the ones that I recommend that I have in here. You want to have at least 200, 250, 500 for your bodily injury. Your property damage should be at least 200. Uninsured motorists, 250, 500. Now, most people are like, okay, well, Lord, there's only a minimum difference in going from 100, 300 to 250, 500. So that's $250,000 per person, $500,000 per incident. So we want to make sure we have these coverages to make sure we're adequately covered, right? So again, you can see here on the collision deductible, I have 500. We also make sure you always have this next one, the waiver of collision deductible. You also want to make sure your insurer has you here. What this does for you is if you have an accident and it's not your fault, and the person, if you want to go ahead and have your insurance company cover this for you, you'll pay the deductible. You'll go ahead and pay the deductible. But once they recoup their money from the person that hit you, they'll reimburse the $500 back to you. But the most important thing too is that if they find that the person that hit you didn't have any coverage, they're still going to give the money back to you. They'll immediately give that money back to you then. But you want to have that on there, because if not, you're going to have to pay your $500 deductible and you won't get your money back, or your $250 or whatever your deductible is. Again, you can see here, comprehensive. We have the lower deductible up to $50. Torn in labor, that's, you want to have that. Also, rental reimbursement, you see it's only $31 for the $31.06 for the entire 6 months, only about $5. That's important. Once you have sometimes you can have your cars out for a month. You don't want to be paying for a rental if you have an accident, right? So I also you see these few down here, replacement costs, lease loan gap. Don't buy that gap insurance from the car dealer, right? Get that with your insurance agent. You can add that right to your insurance. You can add the replacement costs, and that's a lot cheaper. You're going to save a lot of money doing it that way. I see sometimes people come in, they spend $2,000-3,000 on additional. I was like, oh my goodness, no, you don't have to do that. You can add it right on your insurance, right? It's a lot cheaper. I should have added those in here so we can see the dollar amount, but I don't know how to do that. Okay. All right. She hasn't asked. Somebody has a question. Go back, Jennifer, so I can see you.
Oh, sorry. Is that it?
Someone says, Kamaya she wants to unmute, so she has a question.
Okay, hold on a second. Let me find out. I put you on, just a second.
So I can't see everybody over there. If there's somebody else says you're gonna have to, can they type in a question, Jennifer, so you can see them, because I can't see the questions.
Maya, can you unmute yourself?
Yes, I can unmute
All right.
myself, and then I'll use the chat box too.
There you go.
I just wanted to know the gap, the gap
Insurance.
insurance. What is that? Because I recently bought my first car, and my grandma was trying to have me get all this stuff, and I don't know anything like what that means. What it
Go back to that screen. So what gap insurance does for you? So you have a loan that you're paying off for your car. So we all know once we drive the car off of the lot, it's already depreciated and it's worth less than what we bought it for. So sometimes you can be upside down. You can have a car, you can go out, you can have a wreck, and you owe $20,000 on the car. But when they go back and they come back and adjust the car out, they say, okay, yeah, you paid too much for this car. The car is only worth about $15,000. So now you have a gap between the $15,000 that the insurance company is going to pay you for the car and the $20,000 that you still owe the finance company for the car. So what the gap insurance will step in, they'll pay that gap into cover that you still owe the finance company. So that's how the gap insurance works. Okay. So does that answer your question? All right. Any other questions?
Gloria?
Yes, I didn't hear you say anything about earthquake, fire, flood, and hurricane and all of that in terms of rental property and or house property.
Okay, so flood insurance is handled. I suggest everybody have that as well, right? As we saw just down in LA, that you never have flood. And I was earthquake. There was an earthquake, and we had an earthquake there. Flood with all the water we had. I had so many people coming, thinking that their policy would cover, but flood is not going to. Your homeowner's insurance is not going to cover unless it's within inside the home. Anything that comes from the ground up is not going to cover. You need flood insurance. So the pearls that you're talking about, all fire, things that all those pearls are going to be covered under your homeowner's insurance or your renters. You're going to have all the pearls, water, fire, all those are going to be covered outside of flood and earthquake. Flood and earthquake, you're going to need additional policy for. Those are the only two pearls that won't be covered in your either your renters or your homeowner's insurance policy.
Thank you.
Any other questions?
For some reason, I'm not able to view chat, so you might just look down and make sure there isn't anything there.
So I can't really see. Okay, let me see.
You can't either? Okay.
Hold on. Yeah, so I can't see chat either. So if someone I can't see all the people, Jennifer. I don't know if you can see them all. So
yeah, I've got them on gallery. Okay. So I just a moment. You can unmute yourself, I believe, if you need to. Let's see. Anybody else have a question?
Phyllis, this is Cheryl. I have a question.
Thank you.
You know what if you have a storage? I know that comes under like your homeowner's insurance, or how does that work?
So your storage is an extension to your homeowner's insurance. So the things inside of there, you don't need to buy the additional insurance from the storage company, because that will be covered. Your storage will be covered under your homeowner's policy or your renter's policy as well.
Okay.
Okay.
Thank you.
Thanks.
So I had a question from someone my clients called a couple of days ago, and they were asking, they were going to put a van or something inside of a storage. And the thing is, and they were trying to see, the storage company was trying to charge them for the storage. I mean, they wanted them to buy the insurance. So, and she was trying to make sure that the van would be covered and the things in there. So if you take your car, it doesn't matter where your car is. If she put it in the storage, it's going to be covered under auto still. So the auto is going to, if something happens in there, it's still be covered under auto. So anywhere you take your autos, or no matter what state it is, because I have clients that'll call and be concerned because they'll have their kids, they'll take their cars to college. It doesn't matter. Wherever it is that your car in your personal property, if you go out of the country and someone steals your wedding ring there, it doesn't matter where it is. It's going to be covered under your particular property insurance.
I have a question.
Okay.
Related to the storage, that it's the same if you have a shed in the backyard, right? It's still covered as part of your homeowners.
So that's exactly what I just was explaining on when we had the definitions of the different line items that's on your homeowner's policy. Now, on there, but that's going to be at a limit. That's going to be, if you look at your policy, you want to find out exactly the dollar amount that's going to cover. You want to discuss that with your agent to make sure that's going to adequately cover what you have in there. Because some people will go out and, I've had clients that when I had a custom shed or a custom covering, and they didn't increase that on the homeowner's rider. You need to make sure we talk to your agent, make sure to see what that coverage is, the coverage amount, because the system is going to automatically calculate that number for you. That sometimes that may cover, but if you have things that you've done outside of that, it needs to be adjusted.
Okay.
Anybody else?
Thank
I
you.
have one more question.
You can have as many questions as you like, Ms. Walker.
So earlier you had mentioned that I believe it was for the uninsured and underinsured. You said that it should be and it was 250
Go back to
over
that slide.
500.
Yeah, go back to that slide, Jennifer.
So what does that mean? Like the 30 over 60?
Good question. Now, let me tell you. So you see we have under the first slide, it has vehicle bodily injury. Go over to the right. You see the 250, 500 drop down menu. Now, I tell you that most people are not going to have this. The state minimum is only 15. So this first number, 250, Jennifer, and the next number, 500 here, the first number means for every person that's in that accident, in the accident in your car or whatever, they're going to have $250,000 worth of coverage. They're going to pay $250,000 up to $250,000 for each person. The second number, the 500, means that they're going to for the total of the accident, the most that they're going to pay is $500,000. Right? So these are thousands. These numbers are in thousands. Now, remember, the state minimum is only 15. You see, you're going to take the 250. It's only 15,000. Now, I think everybody in here can say, I know their car is worth a whole lot more than $15,000. I mean, even
To replace it, yeah.
It's worth more than that. So that's, and then the higher number is going to be only 30,000. So they're going to have 1530. Don't let your insurance company, most people go, well, I want to lower my insurance, okay, and I want to lower the coverage. Now, know that you're lowering the coverage, but you're putting yourself in high jeopardy of anything happening, because what's going to happen after the insurance company, they're off the hook. Once they pay their $15,000 and the max of the $30,000, the rest goes on to you. And I'm telling you, I've seen people have attachments to their wages. For the rest, you do not want to be underinsured, okay? And it's not a lot of difference. I'll have to explain, okay, you're gonna save, what, $10 here each month for you to potentially be putting yourself in a lot of jeopardy, right? Okay, any other questions, Ms. Walker?
No, thank you. After this, I'm going to call my insurance company.
Most definitely. That's why we're doing it. So we all, these things we all get so busy sometimes we forget about things like this. But make sure you are talking to your insurance agent, your financial advisor at least once a year to make sure you have everything that you have in order is still doing what you wanted to do. I mean, what you put it in place for. Okay. So next up, we're going to do life insurance and investments. Here we go. Okay. So the first insurance, life insurance that I like to talk about is term life. And you can see here, they have your list of things. This is going to be the cheapest thing that you can buy, right? Most of the time when you have, this is what you're going to have. You want to have this in place. This, I tell everybody that if you don't have any insurance, at least have a term policy. You know, you can buy a large amount of insurance for a little money. And, you know, my biggest comeback for people, they'll say, well, you know, I have insurance with my job. Yeah, you do. And that's great. I encourage everybody to purchase their insurance with their with the company. And they're like, oh, I only pay, you know, I'm only paying like $10 a month, and I have like $250,000, $500,000 worth of life insurance, because your company there is. So hold on, I'll answer that in one moment. Stacy, I see you. So what? You know, they're buying insurance because they're buying it at a rate, a group rate, right? Term life insurance still will be, you know, it's affordable. It's the lowest price that you can find. But the only thing about term insurance is only temporary. You can only buy it in the longest term that you can buy is a 30-year term. So after those 30 years, you know, you pay that principal, you know, all those 30 years. And then once it's over, that term is over, you have no insurance anymore. But what you can do, you can convert your term life insurance into something that's permanent. That's another good thing about it. But I always encourage people to put these, at least something on your children early on, just for the example that I'm gonna have here. So, because now with all this gestational diabetes and things of that nature, once those things are set in, when you start taking medication, you're gonna find these premiums going up. I heard that Elizabeth dropped out of my, I didn't hear her whole conversation that she had about her husband, because for some reason, I guess I got cut off. But on there, that she talked about, know that the earlier you do this, the cheaper it's gonna be. So I always encourage my, you know, anybody that's insured with me, have auto and home. I always talk to them, they have children, they're about to go to college or whatever. I always encourage to look, buy a policy now for them. It's gonna be low, but what is it, $10, $15, $20 a month that they can have $250,000, $500,000 worth of insurance. Because first off, they're college now, you know, most people are going loans, and then parents are signing off on those. If something happens to that student, that's going to fall back on you. Have something in place that they, you know, that they can pay, that can pay those loans off for them, is another thing that I like to do. It's a tax-free benefit. You know, sometimes, you know, most households, well, not most households used to be that your mother, father there. If you have a couple here, somebody fall off and you don't die, you want to make sure you can have that backup to have funds that you can make sure you can stay in the same home you're in. And, you know, this is a small price to pay here. So what is it on the chat? Let's see. I had a question here. They said it's difficult to find life insurance being a diabetic. Exactly what I'm saying. What I typically find that when you're 30 is when it begin to rise a little. About the time you're 40, most people, by that time they're going to have a medication they're taking. Anytime you have those things, it's going to increase the premium for you. So I always like to stress the importance of making sure we let our young people know, that just as Elizabeth said her mother told her when she was younger, to make sure we're letting younger people know that they are helping them understanding this is only a small price that they're going to pay for something that they can keep for the rest of their lives. So there are options out there for people with that that's a diabetic, but they're going to table you and it's going to be more expensive. But you have some things that you can do that I usually lead people to do policies that's going to be that you can put in place, but you have to remain living for like 2 years or so. So it makes it a little cheaper for you. And this is, what about plans that don't require medical? So you have some plans that don't require medical evaluations, but those are going to be a little higher. I always tell people, you know, first off, when they're going to do the medical for you, they're going to come out and do medical for you. And, you know, it's an underlying way to see if there's anything wrong. But if you're going to do a plan that doesn't require a medical evaluation, it's probably going to be a little more expensive for you if if you're not doing that. So if you're in good health, you're not taking any, if you're not taking any medication or anything like that, you don't have anything on your strips, I'll say take the med, let them come out and do the blood and urine, and you'll find that you get a cheaper premium in that way. Okay.
Next.
All right. So whole life policies here. So this is, I guess, just whole life policies. So these are going to be more, this is what whole life policy is, more of permanent insurance, right? We have whole life, do we have, what's that next slide, Jennifer? I don't think I even put the, okay, go back. Okay. So, so this is, some people, whole life policies is guaranteed for the life insurance is covered for the rest of your life. So all you have to do is pay the premium. It's not going to change. It's going to be a fixed amount. In the younger you buy it, more premium that you can buy at a younger age. And most people will do a whole life to save within a policy. This is whole life works a little different from whole life. Universal life is going to go with the IUL is going to go with the index. A VUL is going to go with the variables, going to go with the stock market. Those is many ways you can work it. Many people use these types of policies to save inside of that and make it tax free. So these are going to be more of, sometimes whole life is not used as a tax advantage, but VUL and IUL is where some people use those as a tax shelter that they will save inside of there and build generational wealth inside of policies as its nature. What's the next one, Jennifer? Did you have a question? Yeah. Okay. So universal life. So again, another flexible policy here. A universal is usually a good option too. It's going to be a less than your your typical VUL or IUL, and it's just just to provide protection for the rest of your life. And it has flexible pays, and it also builds cash value as well. So any of these policies, I always tell people, if you do have any life insurance policy, make sure you're reviewing it. What some people don't know, you can, some people have a life, I had that for 40 years. Life insurance changed continuously, because now we're going to see it's going to be interesting with this COVID thing that we have going on. So different things would change in your life insurance policy. You don't want, if you have a life insurance policy for 40 years, please have someone review it for you, because 9 times out of 10, you're probably paying for a lot of stuff that you don't, and you probably could get a lot more bang for your buck than you're doing for what the policy had, 20, 10, 15, even 5 years ago. They change them all the time. So now like I said, with COVID going on, most definitely everybody should have their insurance policy reviewed to make sure things that are covered in there that should be covered. Okay. All right. Any questions on life insurance? Here you go, Ms. Walker. My favorite student.
I had a question. I guess I'll ask my first question about the universal life insurance that you just covered. So what are some examples of things that you might be paying for that you no longer need, or you might need to get updated?
On the policies, in the policies itself. So it just depends. So every policy, it doesn't matter what company you're with, every policy is going to have different riders or not that's in there. I would always encourage that when you are looking at your insurance coverage, that you have an accelerated rider in there, which means that when I do review older policies, that's what they don't have. An accelerated rider, you can use life insurance. So what it does is that if you become terminally ill and the doctor says, okay, you only have 6 months to live, you can draw that money from your insurance premium then, usually up to $250,000. They will allow you to do that. And that way, if you want to do, because, you know, some people you can go to different countries, have other things done, procedures that, you know, that they won't do here in the United States. So I had customers that have done that have drawn the money out, went and had procedures done in other countries. And, you know, and then if they come back and they live past the 6 months, the policy is still intact. So most importantly, we want to make sure you have an accelerated rider, but you want to just look at all the lingo that's in there to know exactly, because each company is going to be different. So you'll compare, what you want to do is compare, you want to have your insurance company compare what you had, you know, 5 years ago to what they're offering today.
Okay. And then you also mentioned with the whole life policy, like the generational wealth.
Mm-hmm.
And so does that mean, is that supposed to happen once you pass away? Or can you use that as
you can use it now. I'll tell you. Okay. So right now, some people, well, the interest rates are really low right now. But when you think about just 10 years ago, so I know in my first home that I bought, the interest rate on my home was probably 9%. And right now, you know, we're probably at 3 or whatever. But so what happens is you can make a life policy, do whatever you needed to do. If you, right now, you say you're younger, you're 20 years old, and I know 10 years from now, I want to be able to buy a house. I want to be able to buy a house, and I think it's probably going to cost me, what, about $50,000, $60,000 I need to put down on it. You can present your policy, run calculations, your agent should be able to run calculations for you to say, okay, 10 years from now, I want to be able to pull out $50,000 as a loan and get me a home, right? So that's what you'll be able to do with that. So the thing is, I have one client that I guess he has, every deal he has is like a bucket of money he has, and he kind of formed his own bank within his insurance. So he'll borrow money and you know, all these people are flipping homes now. So he can borrow, you know, $500,000 or $600,000 for these people, and they'll loan them money. He'll borrow it at the 2% from the life policy, but he'll loan it to them at 10%. So he's giving the money, he's still getting paid back, he's getting paid interest. So it's the same thing the bank does, right? That's what, when you pay off your you know, we'll pay our mortgage each month and say, okay, yeah, now I'm going to pay, you know, a little additional. Banks love that, because guess what? Now they can go reuse that money. So you can make your life insurance. I tell people all the time, rich people this is how they stay rich. The Kennedys, you know, you wonder how they build generational wealth through these kind of avenues, because first of all, there's no taxes. You never have to pay taxes on this because it's a life insurance policy. So this is usually the way you want to go to, you know, build some wealth in your family. And then if someone dies, you still have the face value of the policy that you'll have there as well.
You're basically banking on yourself.
Exactly.
Okay, but it's always going to be a loan. It's never something that you get back and then you don't have to.
So now it has to make it tax free. It has to be stated as a loan, because otherwise you're pulling money out, right? So, but you're paying yourself back still. So, okay.
Phyllis talked about just as the example she uses. If I understand it correctly, I'm going to restate it. Mm-hmm. You talked about a person who had enough money in their universal life or variable universal life policy built up. They had maybe.
Yeah. So he has, what he does, so
$50,000 or whatever the magic number was.
Exactly.
They borrowed the $50,000 out of it, mm-hmm. but they used it to flip a house as an example.
Exactly.
And then in flipping the house, they earned a lot more than that. Mm-hmm. And so they were able to repay themselves back and still keep whatever profit additional they may have made.
Exactly.
So that's what I think you were saying. Is that
that's right? Yeah. So that's exactly that. Yeah. You can use example just like that. But yeah. So and the thing too, know that now they don't have to pay taxes on the money that they've taken out, that they've worked with, and then the interest that they paid in it, they can write that off. So it's a way to use everything that you have without doing any of the other paying taxes, things like that that'll decrease the value of your dollar.
So I have a question related to that. So let's say the $50,000 that they paid back to themselves, they don't pay taxes on that, but the additional money that they made,
so let me say
taxes on that. You know, in addition to that 50,000?
You never have to pay taxes on anything that comes from an insurance policy. Insurance policies are tax-free. Yep.
All right.
Unless it's not called a loan, right? It's going to be a loan if you take it. So.
Okay.
And then is there a specific time when you can take out the money? Because so let's say I'm 28. I sometimes have to remember my age. So I'm 28.
Well, that's a good problem.
We all do.
So if I get this and then I say, okay, well, 3 years from now, I want to take the money out. Do they have policies where once you buy it, you can take it out, or do you have to wait so many years before you can take that loan out?
So when you sit down with your tax advisor or your insurance or a person when you're purchasing a policy, you're going to sit down and you're going to talk about exactly what your goals are. So if you're saying you're doing something for 3 years, so what you're going to do, you're going to overfund that policy to make sure you have enough money in that policy. Exactly. If you say you want to take out, 10,000 or, I guess the best example for me to have is what we do here in our family is every time someone have a baby, right, we buy a policy. And we know that right now, 18 years from now, we have to pay to go to college. So we're gonna run calculations to say, hey, 2020, 2018, we need money to go to college. Right now, you're gonna need what, 100, 200, whatever, it doesn't matter, $1,000 to go to college. So this is what is gonna be our goal to take out at that time. Or we can say we're gonna take out $50,000 or $60,000 each year for 5 years, right? So you run those totals, and it's gonna tell you, calculations are smart, right? It's gonna tell you, okay, this is what you need to pay, this is what your projected goal is. Always projected, it could be less, it could be more, right? But because it's gonna differ on the fluctuation of the economy and what's going on. But that's what you do. So you, in there is gonna show you exactly what you need to pay and how much interest you should have, and boom, when you get to be 18 years old, here you go. And that's what people say, okay, you have this is how you really want to set up a college fund. You don't want to do a 529, because if you're doing a 529 to pay for college, then what you're faced with at that time, you have to use it only for that particular person, right? You can't take it, and if you do, you have to use it only for college, right? So they can take this money, do whatever they want to do at that time. For 18 years from now, we can take and say, okay, I ain't giving you no money, it's mine, right? We don't want to do that, but yeah, that's what you can do. But with the 529, you can't do that. So yeah, so what you would do, you would set up, you see what your goals are, what you think you would need, and that's how you come with that goal to see exactly how much you can pull out. You don't have any there's no objections on how you're going to pull out money, anything like that. No, it's not. You're not going to have any of that.
Wow, that's amazing.
Well, there you go. Hey,
that is very interesting. And so are these the ones that are? I know you said the term life one is pretty cheap, but for the whole life policy, that depends on your goals, how expensive it is or how cheap it's going to be. Or are these relatively? So
it all depends on so many factors. So I'll tell you now, everybody's not going to qualify for a VUL or IUL because it's going to depend on your health. That's why we said buy it early. That's why I said, okay, when you have it, do it right then, right? You have small children, do it then. So, or you want to do it before you have underlying health problems, because that way, if you say, okay, if you said, okay, we're going to pay a premium that's only going to be $50 a month, and you put $100 in there, that additional $100 you will be amazed at how much you would save in that 10 or 15, 20 years down the road. Okay. So, so that's how that'll work.
Phyllis, when you talked about converting term life to whole life, and if you wait until after you have some medical issues to go to whole life, is that going to increase your whole life more?
Great thing about it, this is why we're saying do this early. So in the medical that you have, right? So you do it early. The thing is, whatever they rated you at when you were 20, they can't go back. You're going to have to use that same rating when you're 40. So that's why you want to have the medical done early. So once you have that, is already stated. They cannot go back and say they can rate you at the, your rate at 30, but they can't go back. If you were a standard or a super premium or anything like that, that's a rating that you had, that's what you're going to have when you're 40. So that's why it's important. If you have a term life, convert it, and you get to convert it at that same premium rate.
Oh,
Yeah.
so then you convert it even if you have health issues, it doesn't matter.
It doesn't
because you
matter.
already.
Exactly, because you
okay.
already had your medical. They cannot go back and say, okay, we're going to pull medical. You can't do that.
So if you wanted to switch insurance carriers, would they have to?
You cannot. They'll take it. You have to still take the same.
They have
rating.
to take the one that
They'll take the rating. Yeah, they'll take the rating that came with that policy.
Oh, okay. So when I switch to you, you won't, I won't have any problem.
I can always count on Cheryl, huh?
I'm just asking because I'm trying to get to where I can get with you. So I'm just trying to understand.
We'll work it out, Cheryl. We'll work it out.
All right. All right.
Any other questions?
Cheryl, that was a really great point both of you, you and Ms. Walker made from the standpoint of and Phyllis made as well, from converting your policy making sure you buy at a young age so that you can convert it later.
Mm-hmm.
Because we know in our own life, things happen. And so if you are able, for example, to buy your children or grandchildren's policies, and then God forbid later on an accident occurs or they get into a problem relative to their health, whatever it may be. If that rating that occurred when they were younger is what would apply, not where they are now, but the previous one.
Because right now, you'll be amazed at how many kids now is just you have this gestational diabetes, and and once they start to take medication, the rates skyrocket, right? So that's why I tell people as early as possible is what you want to do. And Jennifer, what I just thought about, go back to the home. I forgot. I can put one thing on the home. Another thing for you all to remember here. I didn't put it in the slide here. Forgive me. I'm trying to do things at the last minute.
Which one?
Go back to home, to the home screen here.
There you go.
Okay, here you go. So now look, the home, that's renters. To the next one, go to the next one. Well, we can stay there. But on a homeowner's insurance, people, the thing you want to make sure you do, I don't know why I didn't list this on here, a personal umbrella policy. It's called a PUP. Make sure you talk to your insurance provider on there. It's going to give you an extension of coverage with the limits that you're talking about, Ms. Walker. You're talking about the 250, 500. If you exceed those things. So, and I guess I just thought about this when Jennifer started to talk, is I just had a customer just on her way to the grocery store, right? That's all she's doing. She's going out, buy some things, bro. Had a pileup of an accident worth over $2 million. She's bankrupt now. Then lost everything. So the personal umbrella policy will step in to cover you outside of your limits that you have. So you really have really high limits there, but sometimes you do have these things that happen. It was just a mishap. She dropped the phone, didn't know someone's coming, slammed the back. Other person hit the pole, all just crazy. But personal policy, umbrella policy is very minimal of what you'll pay, but you want to make sure you talk to your agent about having a personal umbrella policy as well. You want to have that, especially if you're a homeowner. I don't know how I forgot to put that on there.
Thank you.
Okay, any other questions?
I do have a question.
All right, Ms. Martinez. How are you today?
Can you guys hear me?
Yes.
Yeah, I can hear you.
Okay. So I had a question in regards to the time frame from which if you draw out a loan, are you required to pay it back within a certain time frame? And secondly, I believe when she brought up the example of like if you want to take out so much money, like in 3 years or whatever, are you looking at when you set up that rate? Are you looking to set it up for 3 years out, or will it still be expanded over like so many years, like 10 or 15 years, but you're able to take out that 10,000 or whatever within 3 years?
Mm-hmm. You're able, the system, so we'll just put numbers in, right? We know exactly what we want to do, and the system will tell us exactly what we need to do to get to that point. And in relations to paying back a loan, you'll put that in the system as well, and it'll extend you to exactly tell you how much you'll pay each month or what do you need to do on your policy. to make sure you're paying a policy, a premium to pay it back that, that's within the range of where you want to be. So all that can be adjusted. It's only just to click a button to change exactly what you want to customize whatever you need.
Right, but is it like, so I'm understanding clearly, like, is it my money when I say 3 years down the line, I need to withdraw 10,000? Am I the one investing that 10,000 that I'm going to be pulling out for my use, or does the insurance somehow come in with these numbers where they say like you're paying only so much a month for $200,000 premium?
Whatever you pull out is yours to use however you want. I guess that's what you're saying. So it's not you use it however you want to use it.
Where are you going?
It's Safeway right here down the street.
So yeah, it's yours to use it. So I'm not sure who am I talking with down there.
I think she was. I'm not sure, but I'm thinking she's asking like, kind of like when with your bank, how you're putting in your money to your checking account. Mm-hmm. I'm not sure if that's what she's asking.
Right. Yes.
Like that's your money, like a checking account money, or is it the loan that they're going to be like, okay, this?
So you're building cash value in your policy. So any cash value that you have in a policy is yours. So to withdraw, right? If that's what you mean, yes, you can withdraw that.
Okay, so if I have a $200,000 policy and I decide 3 years in that I want to draw $10,000 from off of that policy, that's kind of how they look at it that way?
If you have $10,000 worth of premium that you have built up in that policy, yes, you can.
Okay, gotcha.
Yeah. But the funds have to be there. You have to be paid that enough money to build up $10,000.
Okay, that's what I was trying to get at.
We're not saying that you can take $10,000 off of the premium, the face value of the policy. No, that's not what we're going here. It's going to be the cash value, what you built up in there. Okay?
Correct. Gotcha.
And just to clarify, you're referring again to whole life, variable universal life, and universal life policies only, not
index universal life. That's correct.
Not term.
Correct. That's the only policies. You can only do this in policies that build cash value. And the ones that Jennifer just stated, those would be those types of policies. You can't do it with a term, anything of that nature. Okay.
So it only can be universal or whole life.
No. So it can be universal life. It's going to be a little slower to build. You can use variable, which is going to go with the stock market, so it builds a little faster in cash value. You can use index universal life, which goes against the index. And the universal, the index, the IUL, and the VUL usually builds cash value the fastest.
Okay.
Because they go against indexes. Okay.
Let's keep in mind, as she was saying, though, it takes time for
cash value to build
in those accounts. You can't just assume that in 2 or 3 years you're going to be able to withdraw the value. This is a long-term proposition, which is again why it's important and helpful for you to do the young people and yourself at a young age.
Gotcha.
Preferably you don't touch it. But if you do have to, it's available. And the key thing is repaying it so that it continues to build. Otherwise, it's not going to build.
That's right. You're going to lose value there, and you're going to kill the policy because you can't. These are not made to use as a checking account, as we say. Yeah. So it's built to make sure we're using to save or an investment or for retirement or things of that nature. Some people use these as retirement mechanisms as well.
Okay, so I have another question because I'm thinking about how I hear a lot of stories about people losing their life insurance, like stories about that. So is that just because the lack of knowledge, or they're not being provided this information? Because it seems like how can you lose your policy if you're able to draw from off a policy to maybe save that policy, or it doesn't work that way?
But so the only way to lose a policy is not pay the premium. So, but you can have cash value built up in the policy and not have to pay the premium, but they're going to start using the cash value that you have to pay the premium for you. So
Okay.
they lose the policy. You hear people say, okay, well, they had a policy, but they lost it, right? And then they died like the next month. Because the only reason why they lost it, because once you don't pay a premium on your policy, the insurance company is going to send you a letter out and say, okay, now look, we're going to extend you insurance. It's like your car insurance, homeowners insurance, anything else. You still may have it right now, but when it reaches this date, you're not going to be insured anymore. So that's how people.
Gotcha.
Ms. Martinez, you had a question? I know you.
Yes. Well, I just want to say thank you guys for this seminar. I just recently purchased my first whole life policy and got my child one as well. And the information you guys, I just wanted to confirm it because I got it through Transamerica and I hear you work through Allstate. And the person was telling me this and I'm like, I don't believe this. This doesn't sound like this. And why don't we know this if this is true? Why are they not teaching this in school? Wow. So the program that I end up getting with are allowing me to take my insurance licensing class and offer this program to people as well. And I think it's just really great. And I just wanted to tune in and see how other people felt about the insurance and, see other questions. And a lot of it is the same questions, like, why don't we know how to invest in policies? Why don't we know the benefit of the policies? And once we get them, why don't we, $1 million baby, for example, I didn't know that getting my baby a policy straight out of birth would allow her to, by the time she's 50, have a retirement and a benefit to die. So her kids will have pretty much the death benefit as well. But if she needs money while she's living, I've allowed her to accrue that over time. So I just want to take the time and wait to the end and, give you guys a great thank you for this. And I appreciate you for this because we don't know this in our community. And I'm so glad I got mine. And now I'm just excited because I just got my babies in the mail and we're all secured. So I just really want to thank you guys for sharing.
Good for you. So that's why we're here, though. We're here to make sure we educate each other because we just don't know what we don't know, and it's our responsibility once we find out, Jennifer, as I said, me and Jennifer ourselves work together with doing this and to educate people, especially to get them while they're young, to educate people to make sure they are following the right, footsteps and footprints to make sure we're getting this done. Because if most people will do it if they know, but we just don't know. So I always tell people, me and Jennifer, you were both financial advisors. If you think about when we were growing up, you think about how many Black families had a financial advisor in their lives at the time. You usually didn't have it. So that's why I always end with people. I was okay. Get with your insurance agent and your financial advisor each year to make sure. If you don't have one, find one. Don't have to be me, but find somebody that you can make sure that they'll put, make sure you're on the right track to know what you want to do when you retire. And you don't get to that age, you get to 40 and like, oh my goodness. So yeah, because it only takes a small amount to do it.
Yes, definitely. Thank you guys so much. It's been a blessing to be a part of this. And I am actually in the field to become a financial advisor. So I'll be tuned in for whatever seminars you guys have coming up so I can continue to learn and grow. I take my test actually next Friday, Juneteenth, on the 19th.
Good luck to you.
In Sacramento. Thank you so much. And this is amazing. This is beautiful. And we need more of these. So I will be tuned in for sure.
We're good. Thank you.
Absolutely.
Well, thank you so much for joining us. Are there any other questions from anyone else? Put it into chat, or let me see if I can open.
While you're doing that, so I know we just see there's so many different questions, so many things you can do with these policies. Mm-hmm. So just to confirm, so for most people, they're gonna take out the loan. They're going to take out the loan. It's not going to be where they're inputting so much money and then they decide, okay, I'm going to take out like that $10,000 we were mentioning. For most people, it's the loan.
So most people use this for a purpose, right? So it's not, so I'm not going to say most people use this for a purpose. It be either, like I said, it either be college, their home, retirement. It's for a purpose and it's a long-term goal. That you're using it for. So that's what these are usually used for, to make you, to allow you to gain some, income or, a pot of money that you can use. And then the thing about it is that it will be tax-free money. So that's the biggest option. Most people do it because it's tax-free. You don't have to pay taxes on this.
So for example, like right now I have a 9-year-old daughter. So then I would start off with her now, and then kind of, like you said, the college idea, right? Think, okay, in so many years, you're gonna need to go to college.
Yep.
And then, so I'll be trying to put money towards the side that, but then while I'm doing that, should we have like a separate one? Because there's the whole life, there's the.
So you're covered. Once you have a policy, any insurance policy on that person, you're covered. So be it that if your son passed away, we're not, the Lord knows, we're not, but if you do, so you'll have a face value on that policy. Be it if it's $100,000, and to also know this now, they're not going to let you cover kids for some people. I want to have $500,000. Well, they're going to let it. No, you're not going to do that on a kid, because why do you need that? Because insurance is made to make us whole again, is what it's supposed to be. It's not for us to get rich out something inside it. So you're going to have a face value there. So in case something happens to you, for yourself, for your son, if you hadn't built up what you need, you'll have $500,000. He'll be the beneficiary for that. So he'll be covered that way. But if nothing happens to you, he grows up, he's 18 years old now. Now you're ready for college, and you sat down with your insurance agent, y'all run numbers and said, okay, now we think we're going to need $40,000 for the next 5 years. You'll be able to pull $40,000 out. That you should already have that. It should have been, you would already have paid enough premium to build cash value to be able to pull that out. Yeah.
Okay, I get it now. Yeah.
Yeah. So we're not doing it for just it's not a loan mechanism. It's to it's there to help us reach a goal that we want, that we know that we want to do.
Okay. And then are you able to so I know before you were saying, like, if you did have a goal, you might want to overfund.
So that's what it's gonna, yeah. So yeah, that's what's gonna happen. That's what's happening inside of the policy in itself.
Okay.
Okay, it's already doing that. That's how you're building cash value in there. Yeah. So some people, what some people do, what I said overfund, I need to change. So what someone, I said overfund. So some people they have enough cash that they'll take $200,000 and just buy a policy. They don't have to pay another thing in there, right? And if you overfund in the beginning, the more money that you start with is gonna make, what's gonna make it grow faster, right? Or you can go for a long-term mechanism, right? Ms. Martinez, you had a question?
Yeah, I was just going to add in, so if you compare it to like a 401k, for example, people get those for long-term retirement. You're going to get taxed at the end. So the taxes are going to come from the end, and you're going to end up with less money. So people save for their whole life and then realize when they need the money that they don't actually have that money, because now you have state, federal, and all these taxes that come from the end. So if you were to purchase a policy as soon as possible, and at the end, they're telling you it's tax-free. So when you go to pull that money out for the home, or when they go to pull the money out for the car that you want to purchase, or the $10,000 you need, if you paid your premiums on time, or if you did the amount up front, then the money will start accruing from the beginning. So when you go to pull the amount of money out that you need, it's tax-free. So you're not hit with all of these stipulations and fees. And although they say they max you or they match you, they usually take that money back. And the federal government and the state government can now step in and take that money. So you would think you had a $100,000 policy. By the time you're done with state and federal taxes, you only probably got about $40,000. So this policy allows you to save like a 401k, but then also allows you to live tax-free for when you need those purchases.
Okay, I completely get it now. Okay, because for a while I was thinking, okay, you buy it and then it's kind of, you can use it like it's a loan, but now I get it. So I want to
like
make
a savings. You want to consider this your savings, but you're not saving with stipulations. You're saving tax-free. So at the end, you're pulling your money out, which you can purchase.
Yeah, so you want to build in the money first before you start trying to, buy it and don't have nothing accumulated. And
it's not, you don't want to use it as a short-term goal.
Yeah.
Yes.
Okay. Any other questions?
You all have been fabulous. I appreciate all of your questions, Phyllis. You've been wonderful as usual. We have,
Jennifer.
Of course, glad to have you. So our next seminar is on wills, trust, and probate, and it's next Saturday. We encourage you to participate in that. event. We also are starting to do our Summer Girls Reading Program on that date, and you're able to register for that. That is the kickoff meeting, I believe next Friday, the 27th, is when the meetings for the summer reading program start, and they're based on sections, based on grade levels. So please go to our Eventbrite page and register for those events as well. Information, I'm expecting the recordings as well as the PowerPoint presentation to be posted onto our website within the next week or so. So you'll be able to, if you missed something along the way, you can go back and replay it if you'd like. Again, thank you all for attending, and if you want to share it with other people, you're welcome to do that as well. And we look forward to seeing you again at a future event.
Are you all going to share your information, your contact information, or is there a way to?
Oh, yeah, Jennifer can yeah, Jennifer, you want to put that on there?
Is it on your?
I'm, well, my name and an Allstate agent. I'm the only one that you'll find. So Phyllis Johnson, and I'm an Allstate agent in West Sacramento. So my phone number 916-288-9090. My email address is Phyllis, Phyllis, M as in Mary, .Johnson, JOHNSON @allstate.com.
Oh my goodness, that was so long. Is there a way you can type all that?
Let me see if I can do this for you right here. Hold on, here we go. Let's see. Okay, so if I type, what is it?
Type it in the screenshot for
most
chat.
of it I can help type.
So y'all know I'm not very good host. So what do I just type in here? Hold on.
Yeah, just type it to everybody. Yes.
Okay, there you go.
And I'm by phone, so I just need to make sure I heard everything. Okay.
So Phyllis is going to finish typing and then she'll repeat it.
Okay, perfect. Thank you.
Is that all right?
Okay.
You just told me you were. Okay, I turned the air back.
So here you go. So it's in there. So my email address again is my name. It's Phyllis, PHYLLIS, M as in Mary, .Johnson, JOHNSON @allstate.com. My office number is 916-288-9090.
Got it.
In West Sacramento. So if you Google, Allstate agents in West Sacramento, you'll see me there.
But it doesn't matter, like, it doesn't matter where you choose to get your insurance from. For example, if I'm in the Bay Area, I can still get services from anyone who's okay.
Yeah, so you can get Phyllis to assist you. She's licensed in the state of California.
Yeah,
so
throughout the state of California.
Wherever you are, right.
Yeah.
Okay.
California, Tennessee, Mississippi, and I think Illinois.
All right. Okay. All right.
Oh, wow. Okay.
Yeah. Everywhere I have family.
So yeah, thank you so much. This was this was a game changer for me, because I always kind of I've spent so much time trying to pay for my education that I haven't even had time to really focus on like retirement or health insurance. And every time it seems like I've tried to learn something about it, I always had started a new program of school. So I've been in school all these years, but never actually did anything in terms of like work. So yeah. I don't have any retirement or health insurance.
Yeah. Well, that's okay. That's okay. There's no time better than the present. But and that's why it was important to me. I thought I would do it this way, so we can just see, because most of the time we all have car insurance, we all have homeowners insurance. We say, okay, we need it. You call an agent, you pick it up, and then we never look at the bottom lines of what each one of these things mean, or what we should have, what limits we should have. So I thought it was probably best that we just, go through these and, educate on exactly which one of these categories mean and how we should use them. Okay.
Outstanding. Thank you all for attending. And unless there's some more questions, we have about 5-10 more minutes if anybody else wants to say anything before we take off. Otherwise, you're all welcome to leave, and I appreciate your being here. Thank you so much.
Thank you, Phyllis.
Bye,
All right.
bye, everybody.
Take care.
Thank you, Jennifer.
Thank you,
Hey,
Phyllis.
Cheryl.
I'll call you, Phyllis. Hi, everybody. I'll call you.
All right.
Hey, Regina. My, you know, I have to call out my dynamic six girls.
The dynamic
Dynamic
six.
All right.
Go
We know,
my
we know everybody else
NCBW.
with NCW will be upset, but you know, that's what we do. Thank you, ladies.
Thank you.
All right.
Bye-bye.
All right. See you all later. Take care. Thanks.
Thanks, Jennifer.
Thank you, Cheryl. Take care, and everybody. Miss Walker and Miss, gosh, she left already. You guys were fabulous. Thank you for saying and sharing and asking all your questions. It helped to spark discussion, which we appreciate.
Well, thank you so much. I really enjoy this, and I plan on signing up for next Saturday.
All right.
So, yeah, so I'll just, while COVID-19 is happening, I am able to now learn something, you know, about
Yes.
real life stuff. Because some of these people, I don't know if it's just me, but I feel like, you know, there's a mistrust in our communities when it comes not only to the healthcare, but also the insurance. And so you kind of feel like some of these insurance agents or financial advisors are like predatory.
Right.
You know,
They
you're
don't
not
have your
really
best
sure.
interest. Right.
Yeah.
Mhm.
And so, you know, you're not sure. And there's people who will be like, well, find one, but you're like, well, where can I find a good one though?
Right. Right.
You know, who I know is going to give me the advice that I need. Because, you know, I'm one of those types of people where when I find someone, I'm sticking to them for life, you know, and so I don't want to later on down the road figure out like, okay, where's all the money at?
Right.
So thank you so much. And this was wonderful. I can't thank you enough.
All right. Glad to
Okay.
have you. Take
Bye.
care. See you later. Bye, everybody. I'm going to end and stop the recording. Thank you so much. Stop. There you go. Yes.